Hello everyone. This is the part that has been delayed for a long time. I finally got my best and to work the way around it. That this platform somehow does not work with PDF, and I had to do some tweaks about it. But here it is. Here we are, and we are going to talk about the international bonds. So, sorry about that. Okay. So when we first think about international bonds, we need to think about, hey, why are we really interested in international bonds? Well, the first thing that we think about is, well, if we want to do some diversification. So really, the main argument about this is that diversification will work better if we somehow do not focus on our domestic bond, namely our U.S. market bonds, instead and expand the whole thing and to look into the whole world instead of just one nation, one country. Okay, so So let's look at the pros and cons first before we jump into what are they and what types of the international bonds are out there. And at this moment, let's take a moment to examine the motivations and see how are these motivations being served. First of all, the investment in emerging market is similar to other international investment, but with more extreme properties. So a lot of those are actually more high yield. Okay, let me just use another color to make it beautiful. The good thing about it is the high expected return, of course, is always good. Well, since you are taking more risk, you are expecting more return. Diversifying the risk in a domestic portfolio, that is also good. Okay, so you kind of offset some of the domestic risk compared to internationally. Okay, so however, on the other hand, you need to take in a caveat about that part. Right, because bonds and those are especially the type of bonds that are heavily influenced by the monetary policy in each country. Nowadays, with all this globalization between countries, if U.S., for example, is not doing well, then maybe China is not going to be feeling that much happier either. So the disadvantage actually is quite a bit. First of all, it's kind of hard to really get the good idea of an expected return. I mean, the whole world is changing. This area, monetary policy, is closely related to some of the very political side of the whole world, and everything's changing. The market is changing. So the expected return, really, how much is it? Is it really higher, or is it just more volatile? We don't know. Okay. Second of all, there's significant risks which are hard to quantify, and these risks, unfortunately, are correlated. Well, you just told me about diversification. How do you say that they are correlated? Well, unfortunately, typically when everything is running well, yes, you do see diversification. However, when things really go very bad, for example, in a crisis time, and that diversification tend to go away. Why? Because everything tend to go bad together. So, in a good state, they could be good and bad, and it could be domestic good, bad, and then the international is good. However, if you are in a really bad situation, economic situation, it could be both of them are bad. right? So when you are in a bad situation, you were hoping really for a better solution than this, right? You were hoping that something is going to pick you up. That was the main idea of the diversification, but that is exactly when it's failed, when you really need it the most. Okay? And on top of that, does not help is the currency volatility. So we already have enough risk involved in the bond itself. But if you are going to invest in international bonds, then of course not all international bonds are going to be denominated by U.S. dollar, understandably. So there will be additional currency exchange rate risk that is going to be involved once you get, say, for example, the coupon principal payment in other currencies, and then you have to convert, and then the conversion, the transformation, and also the accounting practice will also kick in and gives you additional risk. Fourth disadvantage, transaction cost is high. As you can imagine now, instead of just going into a domestic market with a set of system of broker, now you're trying to go across the country, trying to deal with the brokers and market makers in other country, or somehow get the deal through. So the transaction cost is definitely gonna get higher. And for the same reason, less of the people are actually interested, so the liquidity is going to be lower than the domestic. And understanding, especially compared to Treasury, like Treasury is the biggest sector in the whole world, right? So there is no other government is able to really compete with Treasury. The liquidity over here is often a lot lower. It will be the worst case scenario when things are going to see the default and things in domestic country. We've already seen in the corporate bond part, we talked about it before, how hard it is to really enforce a contract, right? So if we have a corporate bond that is defaulted, you got either Chapter 11 or Chapter 7, right? So it oftentimes entails a court fight, and most of the time you don't get that much back and things like that. So we understand the real difficulty behind these legal fights. But think about it, that instead of having all these legal fights in the U.S., now you will have to deal with everything in a foreign country law, in their domestic courts, in all sorts of different regulations that you may or may not understand. So it's a lot more risky, and it's a lot harder to enforce. So the question is really, a lot of times, can they pay? But will they pay? So even if they are a bit able to, they can pay it, does not necessarily mean that they want to pay it. Okay, so after talking about all the pros and cons, let's jump into it and look at classification. So, of course, there are lots of different types of securities. In order to have an overall idea, we do need to group them or organize them into different categories. So here, there are two main categories. One is called the internal bond market, and the second one is called the external bond market. Okay, so we can see in this illustration that the internal, also called the national market, is really actually not what you are imagining. Okay, typically in your imagination, you're thinking about internal market as the domestic market. However, the foreign market, namely Japanese market, European market, those are all counted as internal market right here. Then what is external market? External market is here called this one, the offshore market will describe it better. Okay, so we call it international market or offshore market or Euro market, really because it does not belong to any particular nation. So if it belongs to any particular nation or country, then that is internal market. Okay, so suppose if we have, for example, a Sony company that is a Japanese company, right? So if Sony is coming to the US, is issue the bonds in US and trade in US, and it is subject to the US regulation, then that is going to be a Yankee bond. Alternatively, a samurai bond can be thinking of, say, a Disneyland, the one that you would be working on. If they issue it in Japan, and is subject to Japanese regulation, then that will be a samurai bond. Why do these companies want to issue a bond in a foreign country? Well, of course, every country's regulation is different, their interest rate is different, so oftentimes there is this benefit to issue it and trade it or get access to another country's market. So really, the foreign bond market and the domestic bond market, both of them count as the internal. So you can think about the internal as if it was like an inside the boundary, whereas the following one, this one instead, the external bond market is instead kind of offshore. Okay, so these are oftentimes called international bond market. So whenever we talk about the international bond market, we have the international but is foreign. You can see the foreign bond market, which is still within a country's bound, and those are still the internal bond market or national bond market. So in here we have the real international bond market. That includes the bonds with the following distinguishing features. And first of all, these are underwritten by international syndicates. It's not just it's not just one company, one country. It's oftentimes the huge conglomerate of some kind of organization across several countries and things. So typically they are offered simultaneously to investors in multiple countries. So instead of getting issued in one country like the internal market does, these are oftentimes get issued facing multiple countries. It can be actually issued outside the jurisdiction of any single country. So that's why people call it offshore. It's kind of it's not subject to any regulation for any specific country, and that's also why it is typically unregistered. So these external bond market is oftentimes more popularly called the Eurobond market. So here we oftentimes talk about this bulk deals. So what is bulk deals? It's really like a wholesale kind of, just like an underwriter, when we talk about any kind of issuance of a bond or stocks before. So one syndicate, international syndicate, is going to approach, or one manager is going to approach a whole bunch of issuers and say, hey, this is the proposal to really issue this batch of a bond, and with this number, this maturity, this coupon, and blah blah blah. Everything is already structured, and then you kind of buying that deal, and then these are becoming more common nowadays. So global bonds. A global bond is actually one kind of international bond that is issued simultaneously in several bond markets throughout the world. Okay, so the global debt issuer usually they have consistent demand for funds. They periodically have to retire it and then get more funding. They need funds on a regular basis and have a high credit rating. The Eurobond market, on the other hand, is divided into several sectors. Okay, so for example, if the Eurobonds are denominated in US dollars, they're called the Euro-dollar bonds. Remember, these are all international bonds that are issued simultaneously, facing many buyers in many countries, and not registered, things like that. So nonetheless, these bonds, even if they are offshore, they still have to be denominated in certain currency. So here, when we're talking about this euro-dollar bonds, really we're referring to that currency denomination. Or if it's denominated in Japanese yen, then it's going to be a euro-yen bond. So that means the difference between the euro-yen bond, can you tell, for example, between euro yen and samurai? Well, yeah, the samurai is some other non-Japanese company going to Japan and issue a bond in Japan, whereas euro yen is an international bond that is issued under by a syndicate and facing several countries and available in several countries, offshore bond that is just happen to denominate it in Japanese yen. So the euro bonds are typically registered on the national stock exchange, and the most common one include Luxembourg, in London, or Zurich exchanges. So even if they can be non-registered in certain in certain area, but they still need to trade. And so if they need to, they choose to be traded on exchanges, they can do that. Or the bulk of the trading is in the over-the-counter market, so which is the arm's length through connection, through brokerage kind of trading. So that is off the exchange. And by far you probably get curious about who are the issuer. We talk about the syndicate, which is a bunch of people grouped together, right? So what are these entities? Well, these could include national governments, it could include corporations, it could be financial corporation or non-financial corporation. It can be supranationals. Okay, so for example, the World Bank, IBRD, which is the International Bank of Reconstruction and Development. Okay, so IBRD and World Bank, these are the most famous example for the supranationals. Just like the regular corporate bonds and government bonds has several types and features, the Euro bonds or international or offshore bonds also have different features. One is the floating rate. Okay, so basically is a stated margin over the London interbank offer rate, the LIBOR, which is what we have seen before. The size of the spread actually reflects the perceived credit risk of the issuer. The more credit risk is for that particular issuer, the higher is the spread or that layer or that difference on top of the LIBOR. So it's going to be a LIBOR plus a margin or a spread, right? So the more risky, the higher the spread. Typically, these are just like what we've seen before. The coupon rates are going to be reset every 6 months, and some of them are stated maturity, or some of them are perpetual issue. So some of them actually have no stated maturity date. They can just last forever. If it's a plain vanilla fixed rate coupon bonds, then we call them oftentimes the Euro straight. Just like typically we call other corporate bonds, if it's not having a lot of features, we just call it a straight bond. Okay, so because these are issued on an unsecured basis, has no collateral, they're usually issued by high quality entities. Remember, these are not typically not registered, and they are hard to enforce. So if it's not issued by a high quality entities, then nobody's going to buy it, right? So of course there's also zero coupon bond and deferred coupon issues and other common types of a bond. Okay, so the coupon payments are made annually rather than semi-annually because of the higher cost of distributing interest. Because now, since we involve a lot of buyers and investors in several different countries, and so the coupon payment is a lot more troublesome compared to the domestic or regular bonds. So instead of semi-annual payment, we're gonna do a coupon that is annual payment. So you might want to ask me that what does it mean by the plain vanilla? Plain vanilla really means in the financial English, the plain. Okay, so why do they add vanilla? I don't know, just to make it smells good. There are some issues that actually pay coupon interest in one in currency, but pay the principal in a different currency. So that big payment at the end, it will come in a different currency. There's also bonds with warrants. So these are the three different kind of warrants. An equity warrant allows the warrant owner to buy the common stock of that issuer. A debt warrant let the owner buy additional bonds, okay, or at the same price and yield as a host bond. A currency warrant actually allows the warrant owner to exchange one currency for another at a set price. So these are interesting features, additional options added onto these bonds. Okay, so on top of the foreign bonds, offshore bonds, foreign, remember those are actually internal, offshore is external. Now we are looking at sovereign. All of them can be kind of grouped together and generally talk about as international bond market, but they are quite different. So what are the sovereign bonds? Sovereign bond market is really the bond market that is issued by these different governments. Okay, so all these governments can be, of course, very different. That's why the different credibility, different ways, different economic and political conditions can really affect their liquidity and the tactics of strategies. The two biggest players here are Japan and Germany, other than US, of course. The US is the biggest. In January 1999, the structure of the market changed with the start of the European Monetary Union, the euro. Okay, so the CMU combined with declining U.S. Treasury, the EMU it becomes huge, and the U.S. Treasury becomes is also declining, so that eventually make the EMU now the largest government bond market in the world. So if we have So not all those sovereign debts are going to be default risk-free, just like Treasury, right? So we, of course, have the need to really give them a credit rating. Typically, there are two different ratings. One is the local currency debt rating, and another one is the foreign currency debt rating. Why do you have to rate it two separate ratings? Well, first of all, the two different ratings actually might be different. That means that country or that government might have a different willingness or ability to pay on their local currency compared to paying a foreign currency. Well, why is that? Because a lot of times these governments are willing to raise taxes and control its domestic financial system, and has potential can generate sufficient local currency. So really they can, in short, they can print money and pay it off. But for foreign currency, then they cannot print and they cannot easily pay it off anymore. When S&P is looking at a sovereign bond rating of the government, they are looking at for the domestic government policies that foster or impede timely debt service. So they first look at the stability of political institutions, and you have an economic system and a structure. They look at a living standard and degree of social and economic cohesion in terms of economic basic condition. They look at the fiscal policy and the budgetary flexibility, and they also look at the public debt burden. Okay, so what do you think after looking at all of these conditions? What do you think about the U.S. condition? What about the U.S. public debt burden, fiscal policy, and everything? Well, I would love to hear about that. And one very important indicator is also the rate of inflation. In terms of foreign currency debt, then they're looking at the interaction of domestic and foreign government policies. So first of all, their balance of payments. Second of all, the structure of external balance sheet, all those bonds that are external bonds. And then they look at the net public debt, total net external debt, and net external liabilities, not necessarily the debt. Here is some old rating back in the days, rating for Indonesia. About 20 years ago, for Indonesia, Thailand, and South Korea during Asian financial crisis. So when we were looking at during the dates, and we can see that from June to December to January the next year, the rating has gone through a lot for Indonesia, right? So for Indonesia, for Moody's, it's dropping 1 grade in 6 months, and for another within 1 month, from the end of '97 to the beginning of 1998, it's dropping another 5 grades. Typically, a similar thing happened for Standard & Poor, that we have starting in June, we starting at BBB, which is an investment grade, then that is going to drop, and after that, and shortly after that, it's dropped to October, it dropped 1 grade, December dropped 2 grade, and at the very beginning of '98, all of a sudden drops pretty frequently to -6.